Good day, guys. Nice to see you again. And we still have a lot of, remaining interesting topics in risk management that we may not be able to meet, face to face for the rest of the semester or even the rest of the year, depending on the situation. Today, we're going to see a super crucial topic called market risk. So market risk, this has been, I think, widely known as the major part of financial institutions' risk, especially after the financial crisis of 1998 in Asia, in Europe, and then contagious to almost all other parts of the world. Okay, so market risk. So you see, as the name suggests, even without like complete or proper economics and finance knowledge, you might be able to guess right from the name market risk. So this is the risk triggered by the market. Right? So because it's triggered by the market, you could easily imagine or conclude that this is part of the systematic risk, or this is the systematic risk itself, right? So it's part of again the systematic risk, right? Because it's triggered throughout the market. So everybody in the market will suffer from the same risk, right? That's why we call it market risk or systematic risk. So again, coming back to the historical, you know, coming back to the history, we know that in 1998 it was a financial crisis, and actually the Basel the First, right, made by the Bank for International Settlements, they by that time they only put credit risk as an integral part of the capital adequacy calculation or capital risk. But in the wake of the crisis, they realized that market risk was an important component and factor in estimating the capital charge or additional capital charge to estimate the capital adequacy ratio, capital adequacy requirement. Okay, so again, with the aftermath of the crisis, we realized that the level and the magnitude and also the timing of measuring and managing the market risks have become more and more crucial, especially to maintain the financial stability, financial growth, and indirectly to maintain the economy, right? Because financial institutions are basically the pillars of the economy. So if financial institutions fall, break down, or something like that, then the economy is at high risk, right? That's why again, one decade later, we experienced another crisis, right? Another financial crisis, but this one started in the United States as a banking crisis, right? And we have become familiar with the term too big to fail, right? Too big to fail. So that's actually the meaning, right? Because if the pillars of the economy, which are the financial institutions, fall, then most likely the economy couldn't survive maybe within 1 year or within half a year. Right. Okay, so let's go into our discussion materials today. Okay, so financial institutions have two types of book. The banking book is like more permanent type of the book, called banking book. We also have a trading book. Turn off this one. Yeah. Okay, so banking book. So items could be the same or similar, but again, their purposes are different. Right? For banking book, is for permanent holding or permanent operations, right? You have cash, you see, you have loans that you give to, you provide to entrepreneurs, to companies, to retailers, and so on. You have premises, right? You have buildings, you have equipment, you have other illiquid assets, and you also have your core deposits, and then borrowed funds, and then of course you have your equity, right? And the definition of capital in financial institutions is quite limited, and we'll see in actually our subsequent chapter about capital adequacy requirement, about the proper definition of capital. I mean, for manufacturing or services firms, we know the capital uh, basically consists of liabilities, your equity, and then your mezzanine financing. But in financial institutions, capital is more narrow, right? It's narrower and also more specific, right? Especially it points to your equity and a little other parts from your liabilities. And then you have trading book here. You see, again, as suggested by its name, trading book means that this book purpose for trading, right? For trading, so you probably don't hold them for like permanent purposes. So you buy and sell for short-term, ready for sales or ready for resales and something like that. So items could be similar, right? You see, you also hold some bonds, right? You hold some commodities, but not for permanent holding. You might have a net long position in, oh, you see here, so they're corresponding to one another. One is long position, the other is short position. And of course, you hold other firms' equities, right? And you also probably you have like short selling, right, of securities. And then you have the ABS, right, asset-backed securities. And in this case, is more specific. This is mortgage, right? Mortgage-backed securities. And you also have long and short positions for your derivatives instruments. Okay, so what was the like? Which book is more prone to market risk? Of course, this one, right? Trading book. And you can imagine easily, right? If you have a trading book, you might have to go in and out, right? Go in and out from time to time. So it creates potential fluctuations and volatility that might affect your the portfolio values, also your liabilities values. Okay, just imagine a situation where you have a certain amount of money and then you use the money to buy anything, maybe bonds or stocks, or you buy gold or anything. And it turns out that like the stock values, right, the values of your stocks actually plunged because of the crisis, maybe recent like health crisis, such as today. You have been holding anything, right, BMRI, right, or BBNI or WSKT or something like that. You hold the stocks, and it turns out that those stocks plunge, right, in values because of the health crisis. Of course, you expect that they would they'll rebound, right, within maybe 1 or 2 months or even 3 months. But uh, if you need the money right now, maybe to pay your tuition or to pay your mortgage or anything, then you'll be in trouble, right? You'll be in trouble because you need to cash in, right? So you need to sell, you need to sell the securities in a short period of time because you need the money. I can imagine that. So this is like what's that, the uh, similar situation, like congruent situation with the trading book. On the other hand, if you don't really need the money right now, you hold them for like permanent purposes, maybe for retirement or for future like children education or anything. although the prices or the stock values plunge right now, of course you are not happy with that, but you still have a lot of time to wait, right? You can wait for the time to for them to rebound because you don't need the money right now. So you see the situation. Banking book is safer with respect to market risk, but trading book is not because you have to go what's that go back and forth. You have to go in, you have to go out. I can imagine the situation, right? Okay, uh, so you see here is the recent financial crisis, like about 10 years ago. One decade ago. It started actually, yeah, started in 2006 with the credit card problem, and then at the end of 2008, it reached its peak of the problem. You see, Lehman Brothers went broke, and there were a lot of financial institutions, securities firms, hedge funds, and all sorts of financial institutions went broke. Went down because of the carelessness, the recklessness in managing risk, right? Especially a market risk. Right? So we talked about this in the earlier part of our discussion about risk management, right? The housing prices plummeted and created a situation where actually the homeowners, right, or the borrowers had no had made two decisions, right? And both were bad, right? First decision was or first situation was they were not or they couldn't afford to pay, right? Just couldn't afford to pay. They didn't have money because they lost their jobs. Right? But the second possibility or the second what's that? Second event that really came out was many people decided not to continue their mortgage payments because they thought that uh, their houses values had plummeted, right? Had plunged badly, and their mortgage period was still very long. So they just abandoned the mortgage because it's not profitable anymore for them to continue the payment, knowing that their house's values had really badly suffered. Right? So it's better to abandon that one, and if they wanted to take another house, they would borrow or they would take a new mortgage with a lower value of the house, right? Because of the plummeting house prices as well. Okay, so you see, a lot of financial institutions got into problem. Lehman Brothers went down at the end of 2008. Merrill Lynch was acquired by Bank of America, and Washington Mutual was taken over by J.P. Morgan Chase and so forth, right? Okay, so this created like even more serious effort to redefine the measurement and management of market risk. That's why in 2009, we know that in 2009 we had Basel, we call it Basel 2.5, right? Basel 2.5. So it's Basel 2, but you know, readjusted or some new definitions, new methods were added into the estimation and management of risk. Right? So Basel 2.5. Of course, in 2019, 2020, we already had the Basel the third, right? That has been applied as of today. Right? Okay, so market risk. Again, market risk, as suggested by its name, this risk is suffered by the whole market. So something is happening to the what's that? The market factors, right? Market factors such as what? Something systematic. So maybe I will repeat a bit, right? So we have, of course, we have two types of risk, right? The big, what's that? Big definition or two big categories of risk. We have systematic. So this systematic risk is also known as market risk, or in stock market you call it beta, right? Beta. So market risk, right? So this is suffered by the whole economic players in the market or in a system or in a market. Right? So everybody in the market will suffer from the same risk. That's why this is not diversifiable, right? This is undiversifiable using a portfolio. How to handle this? This is what we have been discussing throughout several months, right? Throughout the semester. This is about what? Risk management, right? You have insurance products, you have derivative products, right? This could only be handled with risk management techniques, right? And not with the portfolio. And of course, the second one is specific or unsystematic. So unsystematic risk or specific risk is diversifiable, right? Could be diversified away using a portfolio. So again, we are here, systematic risk, so market risk. So this is triggered by the market indicators, market demand and supply, right? So we could mention a lot of examples here: interest rate risk, right? And then the foreign exchange or currency risk, right? And all other things like inflation, even the political turmoil, changes in regime, and all sort of similar characteristics of risk. Also, okay, so interest rate risk, foreign exchange can be measured over periods from 1 day to maybe 1 year or even more than that. But if it's too long, then uh, the accuracy would be lower, right? Because you measure something that is too long. So measured in monetary unit. Okay, so what are they for? See here, management information. We use the market risk measurement for management information. Of course, this is very important, right? To know your position, right? Your precise position with respect to the market risk. So you know the amount of market risk that you are facing, right? That's the another way of saying that. So second one is setting limits. So this could be used by maybe top executives and even stockholders through the board of directors. They could set limits, right? You could tell your uh, subordinates, right? Maybe your subordinate executive could set limit that the market risk that they could be faced with should not exceed like certain amount of money, right? So setting limits can set a boundary or limit for that. Right? Resource allocation. So you would know areas or yeah, anything, maybe your portfolios, even your liabilities that need like special attention because its market risk is high, right? Or it's getting higher, it's showing like an upward trend, right? Which is very dangerous, maybe, right? In your analysis, right? So you could allocate resources based on risk and return characteristics, right, for each item. Of course, it takes effort, right? It takes effort, and again, this is a defensive strategy, so not many people are interested, right? Uh, if you see, yeah, in any area, right, in any sports, in if including here in this context, attacking strategy is always more attractive to people than defensive strategy. And this is a defensive thing, right? Defensive thing. So it looks not that attractive, but if you don't defend your like position, right, your risk position, such as these examples, then you might not be able to survive. That's the problem, right? So you might have like good attacking people, like the good sellers, good marketers, right? Very good at making money, like you have good credit growth and anything like that. But if you don't manage the risk well, then you cannot survive. Performance evaluation. So this is very important. If you have watched the movie Rogue Trader, so it's a very good movie that I suggested in my previous video as well. Right? So Rogue Trader, you could see that. So one guy, Nick Leeson, right? So he was doing the gambling thing, right, with the futures contract. But you know, in the gambling game, sometimes you gain a lot of money, sometimes you lose a lot of money, right? But at the end, Nick Leeson led Barings Bank to bankruptcy. But you know, along the way, actually, at one point in time, he made a lot of money, right? Within 2 or 3 weeks, and he was awarded with, no, like a special star or award by his parent company. That's ridiculous, right? So obviously they evaluated the performance of traders and the brokers and traders using the return side only paying attention to return. They didn't use the what's that, risk-based performance evaluation. And of course now we know more about it, and I think all sane or normal firms in the world will implement the risk-based performance evaluation rather than merely be based on a return, right? As like the measure of performance. Yeah, and of course, another benefit you can see here, you provide the regulators with information about the market risk, right? So and this is required, of course, by regulators, right? By central banks, and also by financial services authority in every country, right? To get this information about market risk from each financial institution. So it's very important for being a warning, right? And also as like policy decisions determiners, one of an important determinants of policy making for the regulators, right? For central banks and financial services authority.